Dear students, we'll be discussing the managerial function of control. Chapter 19, Basic Elements of Control. In this chapter, we'll try to learn the purpose of control in organizations, and that will include looking at the types of control and the steps that are undertaken by managers in the control process. Also, we'll try to look at the three forms of operations control in organizations and look at how budgets and other tools could be utilized for financial control. Further on the learning objectives, we'll try to see the differences between the two forms of structural control. We'll try to understand the relationship between strategy and control within organizations, including international strategy control of organizations. Also, we'll be looking at the characteristics of effective control and why members or employees of an organization may resist control and how managers could actually overcome such resistance. The purpose of control. Control is about the regulation of organizational activities in such a way as to facilitate the attainment of their goals. So you find out that without control, organizations will have no way of indicating or understanding how well or poorly they are performing in relation to the goals they've set. Now, you may also look at control as the regulation of organizational activities so that the targeted elements of performance remain within acceptable limits, right? So, whatever their performance targets, right, the idea of control is such that organizations are still within progressive limits, are within the confines of attaining whatever targets or performance targets they've set. So, how do I mean? I mean that control basically indicates where there may be need for intervention if some elements of performance or some performance targets fall outside the acceptable limit. So when there is control, it actually creates an avenue for intervention, right? So looking at the purposes of control, you find out that it provides organizations with indications of how well they are performing in relation to their goals, right? It provides a mechanism also for organizations to actually adjust their performances to keep them moving in the right direction, right? So you may also want to say that control provides an organization with ways for which to adapt to environmental changes, right? It also helps them limit their accumulation of error or to actually cope with complexities that may exist within or outside the organization. Also, control actually allows organizations to minimize rather their costs. So the diagram on this slide actually illustrates the various purposes of control, right? The areas which control actually aids organizations or helps organizations. Now you find out that control actually helps organizations adapt to changes in their environment. So how do I mean there? You find out that in today's complex and turbulent business environments, right, organizations have to contend with constant changes, right? So a properly designed control system can actually help managers of organizations anticipate, monitor, and respond to changing environmental circumstances. So that's one thing control actually helps organizations with. Now, also, it also helps organizations limit the accumulation of error, as we can see, right? So you find out that over time, small mistakes or may accumulate and become very serious. So those things that may be considered errors, right? They may actually accumulate. So an adequate control system will limit the accumulation of these small mistakes or the accumulation of these errors. That's one other thing control helps organizations with. Now, control also helps organizations cope with complexity, or it cope with organizational complexity, as the case may be, right? So you find out that a business that produces many products from a lot of raw materials and has a large market area, so they may have a complicated design, and many competitors need a sophisticated system to maintain adequate control. So you find out that businesses that have different products, have several competitors, deal in several markets, have maybe internationalized markets like a multinational company that basically operates in different geographical locations that have different environments, right? You find out that such a business, for starters, when we discussed organization, the managerial function of organizing, such a business or such an organization would have a complex organizational design, for starters, right? And such an organization would equally require a sophisticated system for it to maintain control. So control would help such a system cope with complexities that are associated with its businesses. Also, another thing control helps organizations with is to minimize costs, right? So it helps reduce waste. So control systems will reduce waste, invariably reducing cost. It also helps with lowering labor cost, and also control helps improve productivity. All these rather feed into reducing costs for organizations. Types of control. We find out that organizations practice control in a number of different areas, and also at different levels, right? Because there are different managerial levels of organizations, there are different areas, right? Also, and the responsibility for managing control too in organizations is widespread. It cuts across different managers of an organization. So we also find out that areas of control in organizations they actually differ. So most organizations define their areas of control in terms of the four basic types of resources they use, and we understood from the beginning of this class that the four resources we'll be looking at within the context of this class would be the physical resources, human resources, information resources, and financial resources. So you find out also that organizations define their areas of control in terms of these resources as well, which would include the physical, human, information, and financial resources, right? So looking at control of the physical resources, this may include inventory management, right? So how do we mean control of physical resources in relation to inventory management? That would be like for organizations that are into supplying, or rather for finished products, that would include them stocking neither too few nor too many units in their inventory, right? So there wouldn't be like either a shortage or a surplus, right? Now, control of physical resources may also include quality control. That would mean maintaining appropriate levels of output quality, right? And also equipment control. Equipment control may relate to supplying the necessary facilities and machinery. So looking at the control of human resources, this may include selection and placement, training and development, performance appraisal, and compensation, right, of employees. Whatever policies that are in place, or whatever the practices or processes are, that would refer to relating to the recruitment, training, performance appraisal, or compensation of employees. That would relate to the control of human resources, right? Now, looking at the control of information resources, this would include sales and marketing forecasting, right? Environmental analysis, public relations, production scheduling, and economic forecasting as well. Now, we also have the control of financial resources, which will involve managing the organization's financial obligations, right? So that would include managing capital funds and cash flow, collection and payment of debts, right? So this would be all about managing the obligations of the financial obligations of the organization so that they do not become excessive, right? So the firm is always liquid and has cash on hand to meet its obligation, but does not have excess cash also sitting idly in their account or in their checking account. So this is all about ensuring that receivables are collected and bills are paid on a timely basis. Further on the types of control, levels of control. So I would appreciate if we can relate the levels of control to the managerial levels found within organizations. And when I say managerial levels, I mean the top managerial level, the middle managerial level, and the first line managerial level, at which we understand that at the top managerial level is where the strategic goals and strategic plans are set. At the middle managerial level, which is like the departmental or structural or functional level, right? Those are where the tactical goals and tactical plans are set. And at the first line managerial level, that's where the operational goals and operational plans are set. So I would want us to look at these levels of control also from those lenses, whereby the strategic control will happen at the top managerial level, the structural control will happen at the departmental or tactical level, which is the middle managerial level, and the operations control happens at the first line managerial level, right? Whereby financial control will also see that at the base, which is at the first line managerial level, because at the first line managerial level, whatever strategies, whatever goals that are set at the top are all cascaded down to the base of the organization where they are operationalized. That's why they are operational goals or operational plans. Now, looking at the levels of control, operations control, this focuses on the processes that the organization uses to transform its resources into products or services, right? So we understand that organizations exist basically because they provide, maybe they are into manufacturing of products or goods, right? Or they basically exist to provide services, right? So operations control ensures that it basically focuses on the processes by which either these organizations that are into manufacturing actually get into finished products, or how organizations that are into service provision actually get into providing services. Now, looking at the financial control is concerned with the organization's financial resources. Structural control is looking at how the elements of the organization's structure or departments rather or functions are serving their intended purpose, right? So we look at structure. We talked about structure being synonymous to functions, being synonymous to departments, and these are all instituted basically to help the organization attain all its goals, right? So every department or structure or function of an organization exists solely to contribute towards the organizational outcome. Now, strategic control focuses on how effectively the organization's strategies are succeeding in helping the organization meet its goals. So the diagram on this slide is illustrating the levels of control, and like we said earlier on, control can also be broken down by level within the organizational system, right? So you find out that the pyramid we saw earlier on in this class, that basically highlights the top managerial level at the peak of the pyramid, the middle managerial level at the center of the pyramid, and the first line managerial level at the base of the pyramid. We can see that the strategic control can be aligned to the top managerial level, the structural control can be aligned to the middle managerial level, and the operations control and financial control can be aligned to the first line managerial level. Responsibilities of control. The ultimate responsibility for control rests with managers. All the managers that are found within organizations, be it the top managers, the middle level, the middle managers, or the first line managers, right? So you find out that most larger organizations have one or more specialized management positions called controllers, right? So managers are accountable for and involved in activities for which control is their responsibility. So anybody who bears the title manager within an organization is responsible for control, right? So looking at controller is a position. So like we said, larger organizations have one or more specialized management positions called controllers. That was our earlier thought, right? Now a controller is a position in organizations that helps line managers with their control activities. How do we mean? A controller basically is responsible for helping line managers or maybe supervisors with their control activities in relation to their functions basically, and they help with coordinating the organization's overall control system and for gathering and assimilating relevant information. Now, who are operating employees? These are employees that help maintain effective control. They resolve quality issues, they resolve assembly line processes, right? They contribute or partake in the assembly line processes. And we find out that many organizations are beginning to use these operating employees to maintain effective control. The diagram on this slide illustrates the steps in the control process, right? And we find out that regardless of the type or levels of control systems that an organization may need, each control process has four fundamental steps, which include establishment of the standards, measurement of performance, comparing the performance against the pre-established standards, and determining if there is need for corrective action, right? Steps in the control process. So we'll be discussing the steps in details in the steps in the control process in details, right? And the first step, like we said, there are four steps. No matter what type of control or at what level, right? It must follow these four basic steps, which the first is establishing standards, right? This establishment of standards would be the first step, and a control standard is basically a target against which subsequent performance will be compared, right? It forms the basis for comparison. So standards should be expressed in measurable terms and consistent with the organization's goals. And managers must identify performance indicators, measures of performance that so these performance indicators basically are measures of performance that provide information that is directly relevant to what is being controlled, if that makes sense, right? So we'll be looking at measuring performance, which is the second step in the control process, right? We see that performance is a constant ongoing activity in most organizations, right? So performance measures must be valid indicators of performance, and we see that these performance measures they differ across levels of organizations, across functions or departments of organizations, right? These performance indicators may differ across departments of organizations. So valid performance measures too are difficult to develop and difficult to monitor for some activities. So these performance indicators are what you may usually come across, or what is commonly called KPIs or key performance indicators in organizations, right? So you find out that grades that are given on papers and tests are a measure of performance, for instance, for this class, right? And the associated level of pass, or what we may call the indicators for final grades, are reflected on the syllables, are established standards. So when you go to the syllables and you find out that a particular range of your grades will actually give you a particular final grade, that those associated level of passes, those are like indicators, like for this range you're getting this level of grade, either an A or a B plus or a B, you understand? So those are like the B for the range of grade is like an indicator of level of performance, or the A as of for a particular range of grade is an indicator of the student's performance. Further on the steps in the control process, comparing performance against standards. This is the third step in the control process, and it's all about comparing the measured performance against the established standards, right? So you find out that comparing performance against standards will result in performance that is higher than, lower than, or equal to the standards. So it's necessary to define what is permissible deviation from the performance standard, right? And it's also necessary to consider extenuating circumstances, right, that may affect the attainment of those standards, right? Also, there's need to utilize the appropriate timetable for measurement. So the timetable for conducting comparisons, we'll find out that it will vary depending on what is being controlled. So also looking at the last step in the control process, that would be all about considering corrective action, right? Considering rather corrective action. So after the performance has been compared against what the established standards are, the organization would now be able to view or identify if the performance is in tandem with what the set standards are, or what the targets are, or what the preconceived purpose or objectives or the goals were. So in the event whereby there is need to, if it's not meeting up with what the standards are, right, decisions regarding corrective action most often than not will depend on the manager's analytic or diagnostic skills, right? So it depends on how they perceive what the performance is with in comparison with what the established standards were, right? So based on that, after comparing performance against these control standards, one of three actions is appropriate by managers based on their diagnostic or based on their analytic skills. And the first would be is to maintain status quo, right? They probably feel it's not necessary to do anything, so they basically do nothing. The another action they may also consider would be to correct the deviation, right? So if the performance is maybe below what the standard is, then they may consider to correct that deviation, right? Which is to bring operations into compliance with the already established standards, right? Or they may also decide to change the standard entirely. So at the point whereby the performance is being compared to the standard, they may also realize that the standard was set too high, right? Or that the standard was set too low in the event that maybe the performance was so far above the established standard. So you find out also that, for instance, relating it to our class, you find out that during decisions about final grades, right, or what final grade to give students, myself as a professor may decide to stick with what I have already captured in the syllabus as the range for the grades, right? But it depends. I may also decide to alternatively apply a curve if the grades are too far out of line, right? So I can decide to apply such corrective action, which is changing the standard entirely. If the grades of students are too far out of line, I may decide not to stick to the standard which is already contained in your syllabus. Operations control. Operations control focuses on the processes that the organization uses to transform resources into products or services. Now, there are three forms of operations control, and they include the preliminary control, the screening control, and the post-action control. And each of these control occurs at different points in relation to the transformation processes that is used by organizations, right? So looking at the preliminary control, this control attempts to monitor the quality or quantity of financial, physical, human, and information resources that are utilized by organization before they actually become part of the organization or become part of the system. Further on operations control, the screening control, you find out that the screening control basically takes place during the transformation process of organizations, right? So as the outputs are produced, they are screened at checkpoints to make sure that they meet the standards of organizations, right? So, or established standards. So you find out that screening control relies heavily on feedback processes during the transformation process. So, and this one way, a screening control, and an example of that, an effective way to promote employee participation and catch problems early in the transformation process, right? Now, the last type of operations control will be the post-action control, right? And this is all about monitoring the output or results of the organization after the transformation process is complete. So post-action control also can provide the management of organizations with information for future planning, right? And also can be used as a basis for rewarding employees of an organization. The diagram on this slide basically illustrates the forms of operations control, right? Whereby the preliminary control has to do with the input stage in the operations control, the screening control has to do with the transformation stage in the operations control, right? And the post-action control has to do with the output stage in the control process. Financial control. Financial control is concerned with the organization's financial resources. It's all about the control of the financial resources of an organization as they flow into the organization as revenue, as they are held by the organization as working capital and retained earnings, or as they flow out of the organization as payment of expenses. Budgetary control. Budgets Budgets are plans expressed in numerical terms. Budgets may be established at any organizational level. They are typically for 1 year or less, and they may be expressed in financial terms, units of output, or other quantifiable factors. Now, because of the quantitative rather nature of budgets, you find out that budgets provide yardsticks for measuring performance and facilitate comparisons across departments or structures or functions of an organization between levels in the organization and from one period or from one time period to another, right? And also, budgets serve four primary purposes basically within organizations, because they help managers coordinate resources and projects, they help define the established standards of control, they provide guidelines about the organization's resources and expectations, and also they enable the organization to evaluate the performance of managers and organizational units or organizational departments or functions or structures. So on this slide is a table on developing budgets in organizations, and the table captures the types of budgets and what such budgets contains within it, or what such budget captures. So you may want to go through the types of budgets and see what those types of budgets contain within them or what they capture. Types of budgets. So you find out that most organizations develop and use three types of budgets, and those are the financial budget, the operating budget, and the non-monetary budget. Looking at the financial budget indicates where the organization expects to get its cash for the coming time period and how it plans to utilize this cash. And examples of financial budgets will include balance sheet budgets and cash budgets. Now you look at the operating budget, which outlines what quantities of products or services an organization intends to create, and what resources will be utilized in creating these products or services. So it's concerned with the planned operations within an organization. And examples of such operating budget would include the sales budget and the expense budget. Now you have the sales budget and the expense budgets. Now you have the non-monetary budget, right, which is basically expressed in non-financial terms like units of output, hours of direct labor, machine hours. You find out that the non-monetary budget is most commonly used at lower levels of the organization, right? And examples of non-monetary budget will include the production budget and the space budgets. Developing budgets. So we find out that budgets were traditionally developed by top management and the controller and then imposed on lower level managers, right? But many organizations today are basically allowing more participation by all managers within an organization in the budget development process. So you find out that in most organizations, top management generally issues a call for budget requests, right? And each operating unit or department or subunit subunit within a department submits their request. Each operating unit submits request to division head, right? So we find out that division head will be maybe the head of a department, right? So each unit composing that department submits their unit budget to the department. Is collected at the departmental level. Now the division head or the head of the department integrates and consolidates all requests into one overall division or departmental budget, right? And that is forwarded to a budget committee, which is usually composed of top managers, right? So what the budget committee does basically is to check for duplications and inconsistencies in the budgets of all these departments. So for departments whereby that such departments actually work hand in hand, whereby maybe one department's output is another department's input, or maybe they work vice versa, their inputs and outputs go both ways. You find out that they may capture items in each other budget, in the budgets of each other's department, which relates to their workings. So those will be considered duplications, and at the budget committee level, these duplications are actually expunged, right? So the budget committee, controller, and the CEO review and agree on the overall budget, right? So this last process in the development of a budget may actually include a budget defense, whereby the heads of these divisions or the heads of these departments actually come to justify those budgets or the financial projections for their departments. The diagram on this slide basically highlights what was discussed in the previous slide about developing budgets in an organization. Strengths and weaknesses of budgeting. The budgeting process has several strengths, including facilitation of effective control, better ability to monitor operations, ease in identifying problem areas, improved coordination and communication between departments, assistance in planning, and recording of organizational performance. These are things budgeting does, right? And it also has weaknesses, which may include the relative lack of flexibility, right? But there is something called environment, whereby in as much as a budget may be very rigid, right, some elements of a budget may be redeployed to other financial commitments, right, via a process called environment. But most often than not, you find out that budgets are actually lack flexibility, right? And there's another weakness will be the time it takes to prepare the budget and the possible limiting effect on innovation and change, which is provided by a budget. Other tools for financial control. Financial statement. This is a profile of some aspect of an organization's financial circumstances or financial health, or how financially stable an organization is. So a common financial statement is the balance sheet, and a balance sheet is a list of the assets and the liabilities of an organization at a specific point in time. Another common financial statement will be the income statement, and this is a summary of the financial performance of an organization over a period of time, usually a period of 1 year. Ratio analysis. Ratio analysis is the calculation of one or more financial ratios from the information in an organization's financial statement to assess some aspect of the organization's financial health. Now, you find out that organizations use a variety of financial ratios as part of financial control. One of such ratios will be what's called the liquidity ratios, right? And liquidity ratios indicate how liquid an organization's assets are. Now, when you say how liquid, it means how easily converted into cash. How can those assets be easily sold and cash would be raised from the sale of those assets? That's the liquidity ratios. Now, you also have the debt ratios, which reflect the ability of the organization to meet its long-term financial obligations. Now, also there's also what's called the return ratios, which show managers and investors how much return the organization is generating relative to its assets. There's something also called the coverage ratios, which helps estimate the organization's ability to cover interest expenses on borrowed capital. There's also something called the operating ratios, which indicates the effectiveness of specific functional areas or specific departments rather than the whole organization. Financial audits. An audit is an independent appraisal of an organization's accounting, financial, and operational systems. Two major types of financial audits are the external audit and the internal audit. External audits are financial appraisals conducted by experts who are not employees of the organization. Now, external audits basically are concerned with determining whether the organization's accounting procedures and financial statements are compiled in an objective and verifiable fashion. Publicly held corporations or PLCs, right, public liability companies, are required by law to have external audits regularly as assurance to their investors that the financial reports are reliable. Now, internal audits are appraisals conducted by employees of the organization. Like where I used to work, we used to have an internal audit department which composed employees of our organization, which conducted audits, right? But since since I worked for a government organization, we used to actually pay some external auditors to come audit our financial books from time to time, right? Because we are answerable to the populace of Nigeria, because taxpayers' money should be accounted for. That's why external auditors are actually invited. So government establishments too are treated like publicly held corporations or public liability companies, because the population of the country or the citizens of the country are their investors. Taxpayers' money, public organizations have an obligation to citizens of the country, right? So internal audits, like we said, like I was telling you, organizations their internal audit departments are composed of employees of the organization. Now, the objective of the internal audit department usually is the same as the external audit, right? Which is to verify accuracy of financial and accounting procedures that are used by the organization. But the internal audit examine the efficiency as well. They examine whether the organization are doing things right, and also examine the appropriateness of the financial and the accounting procedures that are adopted by the organization. Structural control. Structural control deals with the effectiveness of an organization design. So, how effective is the firm's organization design? That's what structural control is all about. How effective are the departments that are composing the organization? How effective are they? How contributory to the organization's outcome are they? Right? So, you find out that organizational control generally, or structural control generally, falls somewhere between the two extremes of bureaucratic and decentralized control, right? So whereby you find out that the bureaucratic control is characterized by formal and mechanistic structural arrangements designed to extract employee compliance. Organizations that use the bureaucratic form of control rely on rules, strict rules, and a rigid hierarchy. They insist that employees meet minimally acceptable levels of performance, and they often have a tall structure, or what you call a pyramidal structure. Such organizations also that adopt the bureaucratic form of structural control, they focus their rewards on individual performance and allow only limited and formal employee participation. Now, looking at the decentralized control, right, this is an approach to organizational control that is characterized by informal and organic structural arrangements, right, such as group norms and organizational culture, right? So it actually seeks to obtain employee commitment to the organization. Employees are given the responsibility for controlling themselves and are encouraged to perform beyond minimally acceptable levels, if that makes sense, right? So organizations that adopt this approach are relatively flat organizations, right? Organic organizations, and they direct rewards at the group performance and they favor widespread employee participation, unlike organizations that are inclined towards the bureaucratic control. So the table on this slide basically illustrates organizational control and highlights the two extremes to structural control and their dimensions towards what they seek, the degree of familiarity, what the performance expectations of employees are, what the design usually is, what reward systems are encouraged by such structural control extreme, and the levels of employee participation in such organizations. Integrating strategy and control. Strategic control. This is control that is aimed at ensuring that the organization is maintaining an effective alignment with its environment and moving towards achieving the strategic goals it set ab initio. Now it focuses on the structure of the organization, its leadership, what technology it adopts for its conversion processes or transformation processes. It focuses on the human resources of the organization, its informational and operational systems. Such strategic control also focuses on the extent to which an implemented strategy actually achieves the organization's goals. International strategic control. So we find out that strategic control is very important for international businesses or multinational corporations due to their large sizes, complexities that they face in different geographical locations, and also the geographical diversity that actually exists in their areas of operations, right? So you find out that some international businesses or multinational corporations use either a centralized control system, whereas some actually use the decentralized control system. Now, the centralized control system, you find out that in such a system, each organizational unit or subsidiary is responsible for reporting results of performance to their corporate headquarters, right, or the headquarters, which is basically most often than not at the parent country, right? So each subsidiary at a host country in any geographical location actually reports to the corporate office. Now, there are also frequent visits from the corporate office to the foreign branches or the subsidiaries that are actually located in different countries. Now, this decentralized system, you find out that here there are less reports. Reports are less often and in less details from these subsidiaries to the headquarters, right? And the subsidiaries may submit quarterly summaries and full statement or full financial statements just once per year. And also, a decentralized form of international strategic control helps to foster innovation, because you find out that these subsidiaries can easily adapt to the needs of their environment without having to differ to the corporate headquarters. Characteristics of effective control. Control systems tend to be most effective when they are integrated with planning and when they are flexible, accurate, timely, and objective. So you find out that the two managerial functions that actually go hand in hand are the planning and decision making functions and the control functions. Now, looking at integrating the control function with planning, right? You find out that control must be integrated with planning always actually. The more explicit and precise the linkages between planning and control are, the more effective the control system will be. Now, to achieve this, one must account for the control system as the plans are developed. Now, I'll give you an example, right? So you find out that between a manager and a subordinate, for instance, let's say they are planning performance during performance planning, during which the manager has a performance planning meeting with the subordinate where they actually set performance targets for the coming year. So the performance targets will be considered the performance plans. And you find out that during this performance planning meeting, where the performance targets or the performance plans are set, they also come up with a metric, right, or measures for performance or key performance indicators, right, which actually indicate whether the subordinate or employee has attained the expected level of performance or the desired level of performance for the performance plan or for the performance target that has been set. So that metric or measure for performance is a control measure which is set during the planning stage. So at the point the manager and the subordinate are actually planning performance, they are actually controlling for performance by setting the metric, those measures of performance during that performance planning meeting. So you find out that planning should also be integrated with control for effectiveness of the process. That's why in a performance planning meeting, as the performance targets or plans are set, the controls for performance, which are the metrics or the measures for performance, are equally set to be able to measure eventually at a later stage if the employee's performance was congruent or was in tandem with the expected level of or the established standards, which is the metric. You see how planning and control can work hand in hand. So also looking out for flexibility. Also, a characteristic of an effective control system will be the flexibility. The control system also must be flexible enough to accommodate for change, right? Now, looking for accuracy, we find out that control systems must also be accurate to be effective, because inaccurate information results in bad decision making and inappropriate managerial actions. Further on the characteristics of effective control, timeliness, right? So for a control system to be effective, it has to be timely. A control system must provide information as often as is necessary, should provide information as often as necessary, if that makes sense. Now, objectivity. The information provided by the control system must be objective as possible, must be free from bias and distortion as well. Resistance to control. You find out that many employees of an organization will resist control, especially if they feel over-controlled. If they think control is, or if they feel control is inappropriately focused, or such control systems reward inefficiency, then they will resist control. Or if they are uncomfortable with accountability, they may also resist control, right? So, over control. This situation occurs when an organization attempts to control too many things. You find out that employees tend to resist if too many controls are placed on them, right? It's all about when an organization is trying to control many details that affect employee behavior, right? Or when employees perceive control attempts actually are unreasonable. Now you have also the inappropriate focus of the control, right? If the control system focuses too much on quantitative variables and leaves no room for analysis or interpretation, or if the focus is too narrow, problems can actually occur, right? Further on resistance to control, you find out that control rewards for inefficiency. Control systems must not reward inefficiency, right? Rewarding operational inefficiency can lead employees to behave in ways that are not in the best interest of the organization. So, for instance, cutting a department's budget the following year, if not all of its resources are spent, is an example of rewarding inefficiency or punishing efficiency, right? Because the department, when they don't deplete their budget, they report that they couldn't complete all the projects, so they are doing things right. When such departmental budget is cut the subsequent year, this could lead to unethical behaviors towards ensuring depletion of departmental budget subsequently, right? So that's one way of rewarding efficiency, and how that could actually lead to resistance of control by departments actually depleting their budgets even when there's no need to, right? Now, looking at too much accountability, you find out that accountability for one's work is increased when control systems are in place, and this may promote resistance, right? So because efficient control systems are resisted by poorly performing employees because it will expose their laxities within the system.